This video is not financial advice and does not constitute an individual investment recommendation. Imagine waking up on a Tuesday morning, opening your phone, and seeing a notification, dividend credited $412. You didn't sell anything. Didn't work extra hours. A company you own a small piece of simply shared its profits with you. This is dividend investing. And with a specific plan I'll walk through today, this can happen every single quarter within 5 years. Dividends are a portion of company profits paid directly to shareholders. You own 100 shares of Johnson & Johnson. J&J earns billions in profit. The board decides to pay $1.19 per share as a dividend this quarter. $476 lands in your brokerage account automatically. You did nothing. J&J continues operating. Next quarter, same thing again. This is completely different from trading stocks. Dividend aristocrats are companies that have raised their dividend every single year for at least 25 consecutive years. These companies have survived the dot-com crash, the 2008 financial crisis, COVID, every recession since before most of us were born, and continued paying and growing their dividends through all of it. Johnson & Johnson, 61 consecutive years of increases. Coca-Cola, 61 years. Procter & Gamble, 67 years. High-yield savings account pays 4 to 5% APY right now. Sounds good. But rates change. When the Fed cuts rates, your HYSA yield drops immediately. Dividend stocks like Realty Income currently yield around 5 to 6%, plus the dividend grows every year. Plus the stock price typically appreciates over time. Combined total return on quality dividend stocks historically runs 8 to 12% annually. HYSA can't touch that long term. $5,000. Split into 3 positions. 2000 Johnson & Johnson, dividend yield approximately 3%, 61 consecutive years of increases. 2000 in Realty Income REIT yielding 5 to 6%, pays monthly dividends not quarterly. 1000 in Procter & Gamble yield around 2.5%, 67 years of consecutive increases. First year dividend income, approximately $200. Small. But the foundation. The secret that separates serious dividend investors from casual ones: every dividend gets reinvested immediately. Not spent. Not held in cash. Reinvested through DRIP, Dividend Reinvestment Plan. Enable DRIP in your brokerage account with one click. J&J pays you a dividend, it buys more J&J shares automatically. More shares pay more dividends, which buy more shares. Dividend investing on autopilot compounds exponentially over 5 to 10 years. Alongside reinvestment, add money regularly. $500 every month to your dividend portfolio. Don't try to time when you buy. Buy consistently regardless of market conditions. When prices drop, your 500 buys more shares. When prices rise, your existing shares are worth more. Regular buying through all conditions is called dollar cost averaging. It consistently outperforms trying to pick the perfect entry point. Most dividend stocks pay quarterly. By selecting companies with different payment months, you collect dividends every month of the year. Johnson & Johnson pays in March, June, September, December. Realty Income pays monthly, 12 payments per year. Procter & Gamble, February, May, August, November. Coca-Cola, January, April, July, October. A 4-stock portfolio can generate 12 dividend payments annually, 1 per month, every month. Exact math. Start, $5,000. Add 500 monthly. Average total return including dividends and reinvestment, 10%. Year 1, 11,200. Year 2, 19,800. Year 3, 29,900. Year 4, 41,700. Year 5, 54,800. Annual dividend income at year 5, approximately $3,300, $275 per month deposited automatically. 3 selection criteria. 1. Dividend history. The company must have paid and grown dividends for at least 10 years, 25 preferred. Check on Dividend.com or SeekingAlpha.com. 2. Payout ratio. What percentage of earnings goes to dividends? Ideal range, 30 to 60%. Above 75% is a warning sign, dividend cut risk. 3. Financial health. Low debt, consistent revenue growth, strong free cash flow. Avoid chasing the highest yield. Johnson & Johnson, healthcare conglomerate. Consumer brands, pharmaceutical division, medical devices. 61 consecutive years of dividend increases through every recession and market crash. Current yield approximately 3%. Payout ratio around 50%, safe and sustainable. J&J spun off its consumer division Kenvue in 2023, retaining the higher margin pharmaceutical and medical device businesses. One of the safest dividend stocks available. Realty Income Corporation. Real Estate Investment Trust REIT. Required by law to distribute at least 90% of taxable income to shareholders. Yield, 5 to 6%. Pays monthly, 12 dividend checks per year. Has raised its dividend over 100 consecutive quarters. Owns over 15,000 properties leased to companies like Walgreens, Dollar General, and FedEx on long-term triple net leases. Stable, boring, and extremely reliable. Warren Buffett has held Coca-Cola stock since 1988. Berkshire Hathaway collects over $700 million in Coca-Cola dividends annually. Buffett's original cost basis, approximately $1 billion. His dividend yield on cost is now over 70% per year. This is the power of time and reinvestment. Coca-Cola yields around 3% today. 61 consecutive years of dividend increases. Present in almost every country on Earth. Qualified dividends from U.S. stocks held over 60 days are taxed at 0% if your taxable income is below $47,000 single or $94,000 married in 2024. 15% above that. 20% only above $500,000. In a Roth IRA, 0% on all dividends forever. This is why holding dividend stocks inside your Roth IRA is so powerful. You keep 100% of every dividend. The first 2 years are psychologically hard. $50 to $200 per quarter seems trivial. Don't stop. Year 3 changes everything. Dividends hit $500 to $800 per quarter, $1,200 to $3,200 annually. That's real money you can feel. Year 5, $250 to $300 per month arriving automatically. Year 10, if you continued, dividends could replace a meaningful chunk of monthly expenses. Mistake 1, chasing the highest yield. A 15% yield often signals a dividend cut coming, the market is pricing in risk. Mistake 2, selling after the ex-dividend date drop. Stock price drops by the dividend amount on X date, this is normal and recovers quickly. Mistake 3, not diversifying across sectors. All your dividend stocks in one industry means one sector downturn crushes your income. Own healthcare, consumer staples, real estate, utilities. Goal, $1,000 per month in dividend income, $12,000 annually. With a 5% average yield on your portfolio, you need $240,000 in dividend stocks. At the 500 monthly contribution rate starting from $5,000 at 10% total return, you reach $240,000 in approximately 12 years. That's $1,000 per month arriving without working. Every month. Once per quarter. Not daily. Not weekly. Once per quarter. Verified dividends were credited. Reinvest any that weren't automatic. Check that no holding exceeds 30% of your portfolio. Review if any company cut its dividend, consider replacing it. Everything else, ignore the noise. Dividend investing works through ignoring daily market movements and trusting the business fundamentals. Checking daily creates anxiety and bad decisions. Procter & Gamble. Consumer staples. Tide, Pampers, Gillette, Head & Shoulders, Crest, brands used by 5 billion people in 180 countries. 67 consecutive years of dividend increases. Yield approximately 2.5%. Payout ratio around 60%, safe. During the 2008 recession, when markets fell 50%, P&G continued paying and growing dividends. People always need laundry detergent. A 3% yield growing 10% annually beats a 7% yield growing 0%. Year 10, the 3% investor collects 7.8% yield on their original investment. The 7% investor still collects 7%, no growth. Johnson & Johnson has grown its dividend at 6% annually for decades. That compounds your income without adding a single dollar of new capital. Realty Income is a REIT real estate investment trust. REITs own income-producing real estate and are required by law to distribute at least 90% of taxable income to shareholders. This mandatory payout makes REITs among the highest-yielding investments available. You get real estate exposure, historically a strong inflation hedge, with the liquidity of a stock. No landlord responsibilities. Just monthly dividend checks. Free tools for finding quality dividend stocks. Dividend.com. Filter by consecutive years of increases, yield, payout ratio. Seeking alpha, dividend grades and safety scores. Simply Safe Dividends, best for safety analysis, paid but worth it. Start with the Dividend Aristocrats list, 25 or more consecutive years of increases. Your curated starting shortlist of 66 companies. Warning signs of an upcoming dividend cut. Payout ratio climbing above 80%. Dividend yield dramatically higher than historical average, market pricing in cut risk. Free cash flow declining 2 or more consecutive quarters. Debt to equity ratio rising significantly. One warning sign, monitor. 2 or more, consider reducing position. Cuts typically follow these signals by 1 to 3 quarters. In a taxable brokerage, dividend reinvestment creates a taxable event. You owe taxes on reinvested dividends even without receiving cash. In a Roth IRA, dividends reinvest completely tax-free. No reporting. No complexity. Every dividend compounds at full value. This is why placing dividend stocks specifically inside your Roth IRA is so powerful. Tax drag eliminated entirely. When you buy Coca-Cola stock, you own a distribution and branding machine with rights to over 500 beverages in more than 200 countries. Coke, Sprite, Fanta, Dasani, Smartwater, Costa Coffee. The business model: concentrate sold to bottling partners who handle manufacturing and distribution. Capital light. Highly profitable. 61 years of consecutive dividend increases through every economic environment. Optimal account placement for dividends. Tax inefficient investments, REITs, high yield stocks paying ordinary income, go inside your Roth IRA or traditional IRA. Tax efficient investments, qualified dividend stocks like J&J, P&G, Coca-Cola taxed at 0 to 15%, can go in your taxable brokerage. Same investments, different account placement, meaningfully higher after-tax returns without changing what you own. Dividend-growing companies are among the best inflation hedges. Johnson & Johnson raises prices on medical products with inflation. Procter & Gamble raises consumer staples prices with inflation. Revenue grows. Profits grow. Dividends grow. You hold an ownership stake in businesses that adapt prices to inflation, not a fixed dollar payment like a bond. Dividend growth historically outpaces inflation. S&P 500 drops 30%. Your dividend portfolio drops 25%. What do you do? If you have new income or cash, buy more of the same quality companies at a 25% discount. The dividend yield just improved because the stock is cheaper. J&J was paying 3% at $100. Now paying 3.8% at $78. Same company. Same dividend. Better price. Target, $2,000 monthly in dividend income, $24,000 annually. With 4% average portfolio yield, you need $600,000 invested. Timeline with 500 monthly contributions starting from $5,000 to 10% total return, approximately 15 years. No inheritance required. No six-figure salary required. 15 years of discipline and reinvestment. Once per year, 2 focused hours. Review each holding. Has the company maintained its dividend increase streak? Is the payout ratio still healthy? Any fundamental business changes? Rebalance if any single position exceeds 30% of portfolio. This replaces daily trading anxiety with focused annual decision-making. 12 months of ignoring prices. 2 hours of meaningful analysis. The full Dividend Aristocrats list has 66 companies as of 2024. Sectors: consumer staples, healthcare, industrials, materials, financials, real estate. Top by consecutive years: Procter & Gamble 67 years, Coca-Cola 61 years, Johnson & Johnson 61 years, Colgate-Palmolive 60 years, Genuine Parts 57 years, Federal Realty 56 years. Any 3 to 5 of these build a solid core. Enabling DRIP Dividend Reinvestment Plan takes 2 minutes in any major brokerage. At Fidelity, go to Account Settings, select Dividend Reinvestment, choose Automatically Reinvest Dividends and Capital Gains, Save. At Schwab, Account Settings, Dividends and Capital Gains, Reinvest. At Vanguard, My Accounts, Dividend Reinvestment Preferences, Reinvest. One setting. Never touch it again. Dividends automatically buy more shares. The most boring businesses make the best long-term dividend investments. Nobody gets excited about Colgate-Palmolive toothpaste or Church & Dwight baking soda. That's exactly the point. Boring means the business model doesn't change. Demand is constant regardless of economy. Competition is limited by brand loyalty. These predictable businesses generate predictable cash flows which fund predictable and growing dividends. Boring is beautiful in dividend investing. Diversifying into international dividend stocks, companies outside the U.S. Unilever, Nestle, LVMH, ASML pay dividends and offer exposure to global growth. Key consideration: foreign taxes are withheld on dividends at source, typically 15% in tax treaty countries. You can reclaim these through the foreign tax credit on your U.S. tax return. Hold international dividend payers in your Roth IRA to simplify the tax treatment. An advanced strategy to boost income on dividend stocks you already own: selling covered calls. You sell the right to buy your shares at a higher price in exchange for an immediate cash payment, the option premium. If the stock stays below your strike price, you keep the premium and your shares. Added income on top of dividends. Only attempt this after fully understanding options, but it's a legitimate income enhancer for long-term holders. A dividend cut is not a catastrophe if your portfolio is diversified. When General Electric cut its dividend in 2018, investors in a diversified portfolio saw one position affected out of 15 or 20. The response: sell GE if the business fundamentals changed permanently, replace with another quality dividend payer, move on. A cut tests your system. A diversified system survives cuts without material income damage. Where to check dividend history for any stock? Macrotrends.net. Type any ticker, select Dividends tab, shows complete payment history going back decades. SEC.gov. Company filings for official dividend declaration details. Your Brokerage Research tab shows dividend history and upcoming ex-dates. Check 3 sources before adding any new position. Consistency across sources confirms accuracy. Beyond the 66 Dividend Aristocrats' 25 consecutive years of increases exists an even more exclusive group, Dividend Kings. These companies have raised dividends 50 or more consecutive years. Examples: Procter & Gamble 67 years, Coca-Cola 61 years, Johnson & Johnson 61 years, Colgate-Palmolive 60 years, 3M 63 years. 50-plus years of consecutive increases through every recession, crisis, and market cycle imaginable. Most U.S. dividend stocks pay quarterly 4 times per year. A small number pay monthly. Realty Income, most famous monthly payer. Stag Industrial REIT, monthly. Agree Realty, Net Lease REIT, monthly. Monthly payers allow for more frequent DRIP reinvestment compounding. They also smooth cash flow for those living on dividend income. Build a mix, mostly quarterly payers supplemented by 1 or 2 monthly payers for cash flow consistency. You open your account today. By Johnson & Johnson. The ex-dividend date, last day to buy and receive the upcoming dividend, might be 6 weeks away or 6 months away. Check the dividend calendar at dividend.com. Your first dividend could arrive in as little as 6 weeks or as long as 5 months. First payment will likely be under $50. But that first notification, that moment when money appears without you working, changes your relationship with investing forever. Year 10 of disciplined dividend investing. 5,000 start, 500 monthly, dividends reinvested. Portfolio value, approximately $103,000. Annual dividend income, approximately $6,100, $500 per month deposited automatically. You've contributed $65,000. The market and reinvestment generated $38,000 additional dollars. The machine runs itself. Before buying, build a watch list. Add 10 to 15 dividend companies you have researched. Track their prices for 3 to 6 months before buying. Learn how they move with the market. Buy when prices dip 5 to 10% below your first observation. This price discipline, not buying impulsively, improves your average yield on cost. The best time to buy quality dividend stocks is during brief market pullbacks. The investors who succeed with dividend strategies share one trait: they measure success in years and decades, not weeks and months. Your portfolio dropping 15% in a bear market while dividends continue paying is not a problem, it's an opportunity. The investors who panic sell during those drops permanently exit the compounding cycle. Stay in. Reinvest. The time horizon is the competitive advantage that individual investors have over traders. You have the full system now. Next step, open a Roth IRA at Fidelity if you haven't. Search Johnson & Johnson, ticker Johnson & Johnson. Read the dividend history on macro trends. Check the current payout ratio on Seeking Alpha. If everything looks healthy, buy your first $500 of Johnson & Johnson. Enable DRIP immediately. Set a $500 monthly auto transfer to your account. Start. Everything else is refinement. Comment below, which company from today's list are you researching first? Johnson & Johnson, Realty Income, Coca-Cola, or Procter & Gamble? Name one. That's your homework. If dividends make more sense now, hit like. Subscribe and ring the bell for more money breakdowns. See you next one.